Gold is sitting at $4,424 per ounce today. Silver is at $69, and both are deeply in the red while a war is actively being fought in the Middle East, while central banks are buying gold at nearly double their historical average, and while the United States national debt has blown past $39 trillion. If you own gold or silver right now and your portfolio is red, you're probably asking yourself the exact same question that every serious precious metals investor is asking right now. Why? Not the surface explanation, the actual mechanical reason. Because if you do not understand the mechanism, you are going to make the wrong call at exactly the wrong moment, and that wrong call could cost you what may be the most important trade of the next 5 years. I have been studying this pattern for a long time, and what I am about to show you is not an opinion. It is a mechanical sequence that has repeated after every major oil shock since 1973, every single time, without exception. Stay with me, because once you see it clearly, you cannot unsee it. If you are not subscribed yet, do it right now, because what you are about to see is not being shown clearly on any mainstream financial channel. And the part I am going to walk you through at the end of this video, the 4-phase recovery pattern, and exactly where we sit inside it right now. That is the piece that changes everything about how you think about your position today. Let me start with the mechanism, because nothing else makes sense until you understand this. Here is the question that mainstream financial media refuses to answer directly. Why does gold fall during a war? Gold is supposed to be the bomb shelter, the financial safe haven, the thing you own when the world is on fire. So why, when geopolitical chaos is at its peak with an active US-Iran conflict disrupting global energy flows and Brent crude back above $100 per barrel, is gold down from its all-time high of $5,594 set on January 29th all the way to $4,424 today? Here is the 6-step mechanical sequence. Write it down, because once you understand it, you will recognize it every time. Step 1. A geopolitical event causes an oil shock. The Iran conflict has driven oil prices sharply higher over the past several weeks, representing one of the most significant energy supply disruptions in decades. Step 2. The oil spike drives inflation expectations higher, not necessarily actual inflation immediately. Expectations, and in financial markets, expectations are priced in instantly. Step 3. Elevated inflation expectations prevent the Federal Reserve from cutting rates. CME FedWatch data right now shows markets pricing in a 38% probability of a rate hike by December, not a cut, a hike. Traders have abandoned all expectations for rate cuts in 26. That is a complete reversal from the 2-cut consensus that existed at the start of this year. Step 4. If the Fed cannot cut, bond yields stay elevated or move higher. The 10-year Treasury yield is currently trading near 8-month highs and hovering above 4.3%. That is a risk-free United States government bond, paying you 4.3% annually. No volatility, no storage costs, zero credit risk. Step 5. When bond yields are that high, the opportunity cost of holding gold, which pays nothing, rises significantly. Institutional capital does the math, and some of it rotates from gold into treasuries. Step 6. Simultaneously, global investors buying dollar-denominated safety assets strengthen the dollar. A stronger dollar mechanically suppresses the dollar price of gold, because gold is priced in dollars. When dollars are worth more, it takes fewer of them to buy an ounce. 3 headwinds simultaneously, all caused by the same oil shock, that by every conventional understanding should be bullish for gold. This is the mechanism. This is why you are looking at a red portfolio while the world is burning. And here is the critical thing to understand. This mechanical suppression is temporary. I want to show you the 50-year historical record, because the pattern of what comes next is so consistent and so structurally grounded that ignoring it is genuinely costly. Drop a comment below right now. Tell me, how many ounces are you holding right now? Physical, paper, or both? I want to know where this audience is positioned because your answer is going to matter for what I am about to show you. 1973, OPEC embargo, oil goes from $3 to $12, a fourfold increase in a matter of months. Gold falls initially, then gold rises 150% over the following 2 years. Zoom out to the full arc of that period, from the Nixon gold standard break in 71 to the 1980 peak. Gold rose 2,300%. That is not a typo. 1979. Iranian Revolution. The Shah falls. Oil production collapses. Gold does nothing immediately. Then over the following 12 months, gold rises 89%. Then another 10% the year after. 2001, 9/11, markets collapse, panic everywhere, and then gold begins a decade-long bull run from $250 per ounce all the way to $1,900, a 660% move over 10 years. 2022, Russia invades Ukraine, gold breaks through 2,000 for the first time, new all-time highs, every major oil shock in the last 50 years, followed by significant gold outperformance, not because of luck, not coincidence, because the mechanism that temporarily suppresses gold during the shock, higher yields, stronger dollar, forced institutional selling, eventually reverses, and when it reverses, the structural case for gold reasserts itself with full force. Now, here is where 2026 is genuinely different from every previous cycle, because what makes this moment extraordinary is not the war, it is the structural conditions the war landed on top of. In 1973, the United States national debt was approximately $500 billion. Today, it is $39 trillion. That is not a larger version of the same situation. That is a fundamentally different fiscal reality. In 1973, central banks were selling gold. Today, central banks are expected to purchase approximately 755 tons of gold in 2026, still elevated against pre-2022 averages of 400 to 500 tons annually, 3 consecutive years of purchases above 1,000 tons. That is not portfolio diversification. That is strategic sovereign repositioning at a scale the gold market has never seen. In 1973, there was no silver supply deficit. Today, the market is navigating what the Silver Institute has confirmed is a 5th consecutive year of industrial consumption outpacing mine supply, 5 consecutive years of demand exceeding supply, 5 years of inventory drawdown, and silver mine supply is largely a byproduct of other metals. You cannot simply decide to produce more silver because the price has dropped. And in 1973, the Federal Reserve had the fiscal room to raise rates to 20% under Paul Volcker to break the inflationary cycle. Today, the Fed is paying approximately $1 trillion annually in interest on that $39 trillion debt. The arithmetic of raising rates to 20% does not exist anymore, which means the oil shock from the current conflict is embedding into an inflationary environment that cannot be resolved through the same mechanism that worked in the 1970s. Every structural condition is more extreme, every structural driver is more powerful, and the mechanical suppression currently holding gold at $4,424, while JP Morgan's year-end target is $6,300, while Wells Fargo's target is $6,100 to $6,300, while UBS's target is $6,200 by September, is temporary. Like this video, if you have been watching gold get hammered and you still understand why you own it, it is the simplest signal you can give me that this breakdown is reaching people who need it. Let me walk you through the 4-phase recovery pattern now, because understanding which phase you are currently in changes everything about what you do with that information. Phase 1 is the panic phase. This is typically the first 1 to 4 weeks of a major geopolitical shock. Oil spikes. Gold may spike initially on the safe haven reflex, then it drops hard as the mechanical sequence takes over. Financial media runs 24-hour coverage designed to maximize anxiety. What are institutions doing in phase 1? Watching, patiently. They have seen this movie before. Phase 2 is the absorption phase, typically months 2 and 3. The panic subsides slightly, the volatility whipsaw continues. Gold pulls back further from any initial spike, sometimes significantly. Silver tends to fall more than gold in phase 2, reflecting its dual vulnerability to both industrial demand fears and speculative unwinding. This is the phase where the largest number of individual investors make their most expensive mistake. They see red, they read headlines about gold being broken as a safe haven, and they sell. In every previous cycle, phase 2 has been the worst possible time to sell, not because I am always right about what follows, but because phase 2 is almost always the bottom, and selling at the bottom is how you lock in losses instead of participating in recoveries. Phase 3 is the structural bid phase, typically months 4 through 18. The panic-driven institutional selling exhausts itself. The structural buyers, central banks, long-term institutional allocators, physical precious metals buyers in Asia begin accumulating. Gold finds a new bid, not the panic bid from phase 1, the structural bid backed by forces that did not disappear during the correction. Central bank buying continues. Supply deficits in silver persist. Debt dynamics that make monetary debasement an eventual mathematical certainty do not reverse. Let me be honest with you about where I believe we are right now. Based on the price action and the timeline, I believe we are somewhere in the transition between phase 2 and phase 3. The SP Angel Metals analyst Arthur Parrish said something last week that most people reading the Reuters headline will have skimmed past. He identified the current sell-off as a rotation of what he called tourist money out of precious metals. His language was blunt. These are generalist funds and momentum traders who arrived during gold's 66% surge and silver's 135% rally in 2025. They are not wedded to the long-term thesis, and they are leaving. His conclusion was that this exit is probably what the market needs before gold can take another leg higher. The structural buyers are not leaving. The tourists are. Phase 4 is new all-time highs, typically beginning around month 12 and often extending 2 to 3 years. This is what the historical record shows after every major oil shock. The mechanism is always the same. The oil shock embeds inflation. The debt arithmetic of servicing $39 trillion at 4 to 5% eventually overwhelms the inflation-fighting mandate. Rates come down, the dollar weakens, all three mechanical headwinds reverse simultaneously, and gold responds to all three tailwinds at once. Ed Yardeni, while adjusting his year-end 2026 forecast from $6,000 to $5,000 per ounce, is maintaining a $10,000 target by the end of the decade. That is a debt cycle forecast, not a bubble forecast. Share this video right now with anyone you know who is holding gold or silver and panicking, because the decision they are about to make right at this moment in phase 2 is the decision that determines whether they participate in phase 3 or watch it from the sidelines. Now let me give you silver's specific story in this cycle, because silver's behavior is different from gold's, and different in a way that most investors do not fully understand. Silver typically trails gold in the initial phase of a precious metals move, responding to monetary and sovereign drivers. But when the move enters its structural phase, silver catches up and frequently overtakes gold with higher velocity. In the 1979 cycle, gold rose approximately 276% from the Iranian Revolution to its 1980 peak. Silver rose from roughly $5 to $50, a tenfold increase, 3 times the gold move. The reason for that pattern is that silver is both a monetary metal and an industrial metal. In 2026, the industrial demand base is more powerful than in any previous cycle. Every solar panel being installed globally requires silver as a conductor, and that demand is not price sensitive at current levels because silver is a fraction of total system cost. Electric vehicles require 60 to 80 grams of silver per vehicle, compared to 15 to 20 in a conventional car. AI data centers, defense electronics, satellite communications, all of them require silver, and none of them can readily substitute other materials without significant performance loss. And then there is the supply situation. 5 consecutive years of deficit, no supply response coming because most silver is mined as a byproduct. And China, which controls approximately 60% of global silver refining capacity, has restricted silver exports as a strategic material. When the monetary bid returns to silver in Phase 3, the industrial demand that has been running continuously throughout the entire correction period adds to it. That combination is what produces silver's characteristic pattern of lagging gold on the way up and then overtaking it dramatically. As a note, nothing I have presented here constitutes financial advice. Every individual must assess their own circumstances, risk tolerance, and investment objectives. I am sharing what the data shows, not telling you what to do with your portfolio. Let me close with the 2 indicators I am personally watching for confirmation that the Phase 2 to Phase 3 transition has fully arrived. The first is the dollar index, elevated above 99 due to the petrodollar demand surge created by the oil shock. When the DXY falls back below approximately 97, the primary mechanical headwind on gold prices diminishes. The second is the 10-year Treasury yield, currently near 8-month highs above 4.3%. When this falls back below 3.5%, the opportunity cost argument against holding gold weakens to the point where institutional rotation back into gold becomes mechanically favorable. Watch the dollar, watch the yield, not the war headlines, not the daily oil news, not the financial media's 24-hour cycle of drama. The dollar and the yield are the 2 instruments of the mechanical suppression. When they reverse, the suppression reverses with them. There are 3 types of investors watching this unfold right now. The first type sees gold at $4,424 and concludes the trade is broken. They are selling in Phase 2. And 6 months from now, if the historical pattern repeats as it has after every oil shock in 50 years, they will say they knew they should have held. The second type is confused. The price is down, the news is terrible, and they do not understand why. So they are frozen. The third type understands the mechanism. They see Phase 2 absorption, structural suppression, and a structural setup more extreme than anything that existed in any previous cycle. They are accumulating quietly, while the noise is loudest. I have watched these 3 investor types across every major crisis of the last 50 years of market history. I know which type builds wealth, and I know which type watches it happen from the sidelines. Which type are you? Comment below, and if this breakdown helped you see your position differently today, subscribe right now with the notification bell on, because the Phase 3 signals I am watching are going to come through this channel first, and you want to be here when they do.